Welcome to the deep dive. Our mission today is pretty simple, really.
Hmm.
We're synthesizing the data, pulling out the key trends that are driving the 2026 European property sector.
Right.
So if you're looking for that shortcut to where smart capital is moving next year, you're in the right place.
And what's fascinating here is just the massive shift in market mood.
How so?
Well, the source material calls it from caution to conviction.
I like that.
Yeah. As we go into 2026, the chief economist points out that, the risks haven't vanished, but we have moved past the peak levels of uncertainty.
Okay, so conviction is returning.
It is. It's supported by stabilizing economic conditions and, this is critical, improving financing costs.
All right, let's unpack that conviction then. Where should we start? How about offices?
Good place to start.
The narrative seems to be all about this return to core.
Absolutely.
In Q2 2025, something like 75% of all European office leasing was focused squarely on these core central business districts.
Yeah, the absolute prime centers. Think London, Paris, Frankfurt.
And it's not just about having a good address, is it? Companies are prioritizing quality.
Exactly. That concentration, it tells a deeper story. Tenants are trying to future-proof their leases.
What does that mean in practice?
It means this massive flight to quality proves that, post-pandemic, only buildings that hit prime sustainability and access metrics are really viable.
And that creates scarcity.
Incredible scarcity. Core vacancy has tightened to just 7.1%.
Wow.
And if you look at new supply, it's the lowest it's been in a decade.
So that supply crunch directly translates into
Massive rent forecasts. For London's West End, projections are around 10.3% growth. The City of London is at 9.9%.
Okay, so let's pivot here. If the office market is about scarcity of space, the logistics sector seems to be driven more by scarcity of infrastructure.
That's a great way to put it. Occupier activity has stabilized a bit below those pre-pandemic peaks, but the structural support is just undeniable.
From where?
We're seeing a lot of uptake from sectors like defense and, crucially, clean energy supply chains.
So investors see this as essential infrastructure now.
They do. And prime rents are forecast to grow roughly 2.2% between 2026 and 2027.
Okay.
For you, that reliable 2.2% growth, you couple that with attractive lending conditions, and it means logistics is positioning itself as one of the most reliable, lower-risk income plays on the market.
That theme of structural necessity, that also seems to apply to retail, which is seeing a huge transformation.
It's funny, isn't it? 5 years ago, everyone said the high street was dead.
Right. The retail apocalypse.
Exactly. But now, investors realize physical retail is essential. It's just changed its job description. It's a brand experience hub now.
And that's showing up in the investment volumes.
Dramatically. Retail now makes up 16% of total European investment, which is a big jump from the 12% trough back in 2021. And prime rents are looking at solid 1.9% annual growth.
Okay, and then you have the living sector. And just to be clear for everyone, we mean residential rentals, student housing.
Senior care, all of it.
Yeah.
And this area remains just fiercely competitive.
Why is that?
Because the deep demographic and societal trends are consistently outpacing any new supply.
Right. Building permits are at multi-year lows in places like the UK and Germany.
Exactly right. That lack of supply meeting unrelenting demand, well, it translates directly into these high rent forecasts for 2026.
What are we talking?
Spain is looking at 5.3%, the UK at 3.7%, and Germany at 3.1%. The fundamentals here are just rock solid.
Shifting gears to what we could call the new infrastructure. Let's touch on hotels.
Sure. It's a pretty straightforward story. The tourism recovery is fueling investment. Hotel stays are forecast to rise by 5.6% in 2026.
And what's the investment volume?
Expected to exceed $27 billion.
Yeah.
And what's interesting is how it's splitting. Luxury properties saw 72% growth.
Okay.
But investors are also flocking to economy and mid-scale hotels, which saw 50% growth. They just love those efficient operating models.
But the real story, the fastest growing segment, has to be data centers.
By far. It's not even close. Demand is accelerating at a pace we've never seen before, all because of AI, cloud computing.
Digital transformation in general.
Right. And here's the one metric that just changes the entire map.
Go on.
IT load in the EMEA region is projected to grow at a compound annual rate of up to 32% between 2025 and 2030.
32%. That's just staggering growth.
It is. And it's forcing a major geographic shift.
How so?
Well, Western Europe's main hubs are hitting a wall. They have severe power availability constraints.
So the grid just can't handle it.
The grid is saturated, permitting is a nightmare. So development is being pushed to emerging hubs like the Nordics, which can offer scale and, importantly, carbon-free energy.
So the future of data isn't just about speed, it's about green power.
It's about reliable green power. Exactly.
So let's bring it all together. What's the core takeaway for you?
I think the momentum building for 2026 is really driven by these twin forces. You have improving economic fundamentals on one hand,
Mm-hmm.
and on the other, these deep structural trends like digitalization and sustainability.
Mm.
And those forces are just fundamentally reshaping investment strategies everywhere.
Okay, so here's a final thought for you to chew on. Given that 75% of office leasing is piling into these prime core areas,
Right.
and data centers need these massive, reliable power grids, how much further can that gap between premium and non-premium real estate assets possibly stretch in the next 5 years? The disparity between the best and the rest is widening dramatically. We'll see you next time.